Hello and welcome to the Business Standard Morning Show. I'm Swapnil Joglika. It's 26 September 2023 and here are the questions we're going to answer today. Could WhatsApp become India's first super app? Why are Chinese electronics brands losing market share? What does the India-Canada rift mean for markets? And what is OCI card? After hooking over 40% of India's population over the last 10 years, WhatsApp is now planning to capitalize on its massive popularity. Its parent company Meta is all set to roll out WhatsApp Flows in India. It will enable users to make in-chat purchases from businesses without having to switch between apps. So where is WhatsApp heading? Will it become India's first super app? Kasturi Akhil pings experts for the answers.
After introducing several features like WhatsApp channels and in-app payments, Meta recently announced a new update in India called WhatsApp Flows. Now, users will not just be able to book flights, order food or groceries, etc., but will also be able to pay from diverse platforms besides WhatsApp's own, all within the same chat window. By integrating all commercial features and services that one might need in a single app, it is being said that WhatsApp could soon position itself as a super app. A super app essentially is an application that serves as an all-encompassing commerce and communication platform that can cater to practically anything a phone user with an internet connection may demand. This concept is not entirely new to India. Several conglomerates like the Tata Group with Tata Neo and Reliance through its MyJio app have tried to ace the game before. Paytm too has tried to diversify its services and become a super app of sorts, but the consumers wanted more. Experts point out that all these contenders fail to effectively address the very ethos of the Indian market. First, their diverse choices, and second, their resolve to hunt for a good bargain. Choices they offer are limited. Since India got a little late to hop on the bandwagon, many apps already have established their dominance in different spheres, like Zomato when it comes to food delivery, Uber and Ola for cab rides, Amazon and Flipkart for online shopping, etc. So for a single app to be able to challenge what all these existing apps have built so far, whilst ensuring better quality, best price and best choice is a Herculean task, but certainly not impossible. Globally, apps like WeChat and Gojek have been able to crack the code in China and Indonesia, where super apps prevailed even before the niche apps made an entry. So, what gives WhatsApp an edge in the super app space?
So I think there's an inherent advantage to a chat service that has almost 600 million users, where people are familiar with the interface. So integrating social commerce, integrating commerce into it, integrating in payments into that, obviously makes sense. So I think WhatsApp is well poised to indeed become the first super app that takes off.
Meta has already flagged off the concept in Singapore and Brazil earlier this year, and considering India is WhatsApp's biggest market, chances of the app replicating WeChat-like success in India are quite high. According to media reports, WhatsApp Business is set to hit a revenue of $1 billion in India by the end of this year. However, expansion of business engagement on WhatsApp comes with its own set of problems. Unchecked rise in spam messages could potentially dampen the new update's growth.
I think the moment the load of business chats becomes heavy and one gets unwarranted chats, I think there's a danger of some degree of fatigue. We all saw text messaging or SMS go through that phase, where at one time SMS was very critical to all of us, and today SMS is largely relegated to spam or OTP responses. I think that's a big watch out. So how they navigate that, how do they keep the app still clean, great on its UX, and very simplistic without having an overload of business messaging and without making it very spammy, I think that is going to be the challenge.
Moreover, Unlike its competitors, which are primarily Tata, Jio, and Adani, WhatsApp cannot leverage a host of subsidiary companies that are consumer facing. Tata can sell everything from tickets to hotel rooms to medicine to salt. Jio can sell everything from mobile phones to Reliance consumer products, all on one app. How can WhatsApp compete with this?
The best mechanism to have a super app status probably would not be there in a traditional sense if you were to look at international examples, whether it's in China or Indonesia or elsewhere. However, I think if you have very strong strategic collaborations like that of WhatsApp and Jio, or for that matter, of some of our, if tomorrow WhatsApp or Meta were to tie up with some other service providers in India, and the uniqueness of the Indian market and the Indian, cultural, situation with regard to driving best markets and also the seasonal approach with regard to the Diwali season approaching and stuff. I think that could probably help WhatsApp achieve that status.
In August last year, WhatsApp collaborated with JioMart to enable grocery shopping on the messaging platform, a first for India. Experts thus argue that WhatsApp might be able to gain a foothold as a super app in India, but not so much without leveraging the services of its competitors.
Do you know that WhatsApp is banned in neighboring China? It could have been as big a market for Meta as India is. Moving on, Chinese electronics brands are facing some tough competition in India. The market share of Chinese TVs has been sliding for a while now. While Indian electronics wearables also continue to bleed their Chinese competitors. Abhijit Kumar looks for the latest trends and finds out the reasons behind this phenomenon.
For nearly a decade, Chinese electronics brands like Xiaomi, OnePlus, and Realme have established themselves as household names in India. Their affordable yet feature-packed devices appealed to Indian consumers, capturing a significant market share in smartphones, TVs, and wearables. However, the trend has seen a reversal in recent years. Data from research firm Counterpoint Technology shows a fall of 2.1% from 35.7% to 33.6% in the Chinese TV shipments during the April-June quarter this year as compared to the same period last year. Experts believe that the market share might have fallen as low as 30%. Chinese brands Xiaomi, OnePlus, and Realme, among others, disrupted the Indian TV market in 2017-18. They launched entry-level TVs at reduced prices, going as low as 50% less than leading brands like LG, Samsung, and Sony. The price war became fierce. Experts attribute the fall of Chinese market share to the global pandemic. The outbreak of COVID-19 disrupted supply chains, causing delays in product launches and manufacturing. Another problem that the Chinese consumer electronics companies faced was inventory pileup due to a low demand. Anshika Jain of Counterpoint Research hints at a shift in the consumer demand for TVs.
So what we are seeing is the trend of premiumization, which means that the price point is slightly shifting upwards and people are willing to pay a little bit more for premium quality, better features.
Industry insiders say the focus of Chinese brands has shifted to reducing cash burn over the accumulated stocks. This prompted them to focus more on the profitability from mobile devices. The fall in market share of Chinese brands in the TV segment also helped revive LG, Acer, and Samsung that pursued the customers aggressively with advertising and new features.
Right now, what we are seeing is global brands are gaining the share as of now because what they are doing is they are adopting aggressive pricing. They are launching more products. They are upgrading their product portfolio. apart from giving attractive deals and discounts through various festive offers and through offline expansion as well.
But the trend is not limited to TVs. Indian brands outcompeted their Chinese counterparts in the wearables segment that includes smartwatches, fitness bands, and personal audio devices. According to International Data Corporation report, while the wearables market has grown by nearly 47% from calendar year 2021 to 2022, the largest market share was captured by Indian companies such as Boat, Noise, and Firebolt. India's electronic wearable production reached 8,000 crore rupees in FY 2023. Indian electronics companies reinvented themselves with innovation, quality, and aggressive marketing. The Chinese brands, on the other hand, are now focused on capturing the premium segment of consumers. Additionally, the government's Make in India initiative has incentivized local production, giving Indian brands a competitive edge.
Indian brands have created a new market for themselves. They are providing a value product which is rich in features and at a right price, affordable price.
In the evolving world of consumer electronics, the decline in Chinese market share in India is not a story of one's loss and another's gain. Indian players are rising to the challenge of global competition, leveraging their strengths and delivering affordable yet luxury consumer experience.
Indian financial markets, meanwhile, are in the grip of unease. The surge in crude oil prices and fear of global interest rates remaining high for some time have unnerved the equity markets. Add to this the ongoing diplomatic rift between India and Canada, and you get a recipe for high volatility. But what exactly does this geopolitical tension mean for the markets, and how much of an impact can it have? Harshita Singh finds out in our next report.
After a strong first half of September, equity markets have waded into troubled waters on renewed hawkishness from the US Fed and the simmering India-Canada tensions. The Nifty 50 index has retreated nearly 3% from its all-time high of 20,222 that it touched on September 15. This comes as the India-Canada standoff, which has seen tit-for-tat diplomatic expulsions and suspension of Indian visas for Canadians, has also raised concerns over its impact on the equity markets. Canada-based FPIs held Rs 1.77 trillion worth of Indian financial assets as per the latest data, which makes Canada the seventh largest country for FPI flows into India. 85% of these investments are in the listed equity space, while the remaining is in debt and hybrid instruments. The Canada Pension Plan Investment Board, or CPPIB, which is among the largest global retirement funds, remains the top Canadian investor in India with holdings in over 70 listed firms. At the bourses, stocks that are a part of its portfolio and that of other funds have been on a slippery slope since last Monday when the diplomatic strife first came to light. Shares of Kotak Mahindra Bank, Nykaa, Zomato, Paytm, Piramal Enterprises, Metropolis Health and Mahanagar Gas, among others, have lost up to 5% during this period. Analysts, however, are not too worried as they believe such large global funds are generally focused on driving investor value and look beyond short-term diplomatic shocks.
While there have been ongoing diplomatic tensions between India and Canada, one does not expect it to impact the commercial side and the investment side in the medium to long term. Yes, market participants have been a little concerned with the fallouts. However, we think even if it's the Canadian Pension Plan Investment Board, which is government-owned, is unlikely to sort of wind down the investments in India too much. We think that, organizations like these are led by a team of professionals whose primary focus is to ensure that, the their investors make the best returns.
Sharing similar views, Anirudh Garg of Inva Asset PMS believes the India-Canada rift largely remains a temporary turbulence for the equity market. He says, CPPIB and other Canadian entities known for their long-term investment perspective typically do not react hastily to geopolitical events. They maintain a strategic outlook and are likely to wait for developments before making major adjustments to their investments in India. Thus, while markets are expected to remain volatile in the short term, any progress on the geopolitical front could pave the way for a recovery, analysts note. Today, on September 26, the Lal Street action will remain stock-specific and traders will keep an eye out on crude oil prices.
He's making plans for an early retirement. Business Standard.
Staying with the theme of India-Canada rift, reports of New Delhi mulling cancelling registration of some OCI card holders for carrying out pro-Khalistan activities are doing the rounds now. But what are OCI or Overseas Citizenship of India cards? Tariq Ahmed explains.
The Overseas Citizenship of India or OCI card is a significant document issued by the Indian government to people of Indian origin who are foreign citizens. This card is designed to establish a strong and enduring connection between the Indian diaspora and their ancestral homeland, offering a range of privileges and benefits. In order to register as an OCI, the foreign national must either have been eligible to become an Indian citizen on 26 January 1950 or have been one at any point after this date, or if they were a resident of a territory that joined India on 15 August 1947. Children born abroad to two Indian citizens are also eligible to apply for OCI status. The children, grandchildren and great-grandchildren of former Indian citizens or those who were previously eligible for OCI status are all eligible to apply for OCI status. Also, foreign national spouses of OCI holders or Indian citizens are eligible to apply for OCI card after they have been married for at least 2 years. One of the most significant advantages of holding an OCI card is the ability to travel to India without requiring a traditional visa. It allows them to visit India for any purpose, be it tourism, business, or family reunions, without the hassle of obtaining a visa. Also, OCI card holders have the right to own property in India, similar to Indian citizens. This can be especially valuable for those looking to invest in real estate and maintain family properties. OCI card holders can take advantage of employment opportunities in India and even establish their own businesses. The OCI card facilitates admission to educational institutions in India, allowing card holders to pursue academic interests, research projects, or professional development. OCI card holders can also operate bank accounts, purchase investments, and engage in financial transactions in India, making it easier to manage financial assets and investments. This card strengthens social and cultural ties by providing access to cultural events, heritage sites, and other community activities in India. OCI card holders do not require exit visas for departing from India, which simplifies travel arrangements, and it is typically valid for the lifetime of the card holder. While the OCI card offers numerous advantages, it does not grant Indian citizenship. OCI card holders are not eligible to vote in Indian elections, hold public office, or apply for certain government jobs.
The nation's trusted bank, SBI, the banker to every Indian.
Just like the OCI card, India used to issue Person of Indian Origin or PIO cards for foreign nationals who could establish at least a third-generation tie to Indian origin. But it was merged with OCI cards in 2015. Well, that's all for today. For more news and analysis, please log into business-standard.com.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.